Mridul, I'll start with you. What did you make of Asian Paints numbers?
Numbers predominantly was in line to the expectations. What was surprising was the two parts. One was slightly on the product mix and the fact that the volume growth was in a small double digit, which is fine because it's a monsoon season. What surprised the market probably was the price action. I think adjusted to the revenue and volume, there was a price decline of 1%, which I think market was not expecting. What it means is that if the crude continues to go up, they may not pass on the crude price hike, which means I cannot put my earning upgrade on the margin side. And we know the economic situation the way it is. So if economic growth headwinds continues, your volume growth will have an issue, your margins will have an issue, and the stock is not cheap. When that is the situation, then some profit booking is possible because the stock is up around 40% in the last 6 months.
Okay.
So that gives a headroom for investors to book profit. And anyways, ahead of budget, investors will want to go a bit light on their books. So for me, this is a normal reaction. I will not read too much into it. At these valuations, I'm not a buyer, but not an aggressive buyer.
So if someone wants to take, obviously Asian Paints is a quality company. Crude obviously has managed to cool off from the highs down almost 5% in the last few days. For someone who wants to take a slightly longer term perspective, would you advise him to buy at this level, or you feel that buying only on a correction would make sense?
So I'll start buying at around 1700, but I will not be surprised if with the market it comes down to 1550 odd.
Okay.
So I'll spread my investments.
Okay, that's
4 numbers.
Okay, Mridul, what did you make of L&T?
Yeah, so L&T for us is a slightly complex company to understand. Typically, the investors tend to just look at revenue and decide on the numbers. That's not true for L&T. L&T, you have to look at multiple segments. You have to understand from an order book perspective and margin perspective. So while the revenue booking was weak, everything else was quite good. And the revenue booking was weak because of one segment, which is the infra segment. Now, infra segment, nothing is moving in last 3 months. We know that. So practically, that is what is getting reflected in the numbers. The fact that the company continues to have good order book, predominantly from international business, just shows that the health of the company is predefined in terms of focus. Now, the stock has not done much throughout the year. I think it's actually given an underperformance to Nifty as a return, while I need to exactly look at it. What it gives is a conviction to buy in correction, because this is one direct play where if you have to play the economic revival story, one of the better plays after cement is only Larsen. In fact, that's the only play for us. So which means that if the stock is a value, you will see investors at lower level because of the management commentary, and besides the top line number, everything else was fine. So I kind of agree that this stock is a buy at a lower level. I will see it more of a value buy rather than a growth stock at this point of time. For a growth stock or something where you expect a return in 3 to 6 months, Larsen is an avoid.
Okay. You think the management has already said that they are confident of meeting the guidance both on the revenue and order front? If you're looking at it, they need sizable amount of orders to come in into the fourth quarter to meet the guidance. Even on the revenue front, the 9 months they've grown at 10% when the guidance is higher. You think Q4 will be tough for them to meet the guidance, or will they be in a position to do it?
I will trust the management.
Okay.
That's where I will not say it will be easy for them, but I will trust the management that so close to the quarter end, if they still are confident about it, which means there are pipelines for them. So which is why the market also trusts the management, which is reflective of the price, that even though the bookings were lower this time, some might have got rolled over. So my sense is I will trust the management, but I will not be a buyer for a short term.
Okay, what's your...
If you look at it, HDFC Bank and Kotak Bank have corrected because they have shown lower growth, and they have said that we see challenges in the growth because there could be pain points. Those corrections have come because they were highly valued at more than 4 times price to book. If you say that I will not grow as aggressively, some profit booking will happen. IndusInd Bank, the way they corrected is because MFI has stress. That is clear from all the 5 con calls and management interaction that parts of MFI has issues. Now, post the merger with IndusInd Bank had with Bharat Financials, it's very clear that they have a high weightage to that, and CVs have their own challenges, which is why IndusInd Bank is a avoid for us. Talking about the rest, we really like HDFC Bank, ICICI Bank, in that order. And we believe that both will be an opportunity to buy. While ICICI is yet to report a number, typically it's always in line with what Axis reports. So which means the slippages could be a stress, but these two guys kind of are in that valuation zone where the stress is in the price. Don't see immediate upside to them. They will be market performers, but they will not be an outright market outperformer, which they have been over the last 6 months.
What would you make of the smaller banks? Do you think that this time around they did better? Look at the numbers that, somewhat like an AU Finance pulled up and all. Do you think it's time for the market to start, shifting portfolios from some of the larger banks to some of these other banks?
We as a strategy remains only in large caps.
Okay.
The way I look at it is, again, which is why we don't paint everybody in the same brush. Each have their own core and segments of growth. AU grows is a different focus part, and the quality is very different. So yes, AU is something which will always trade expensive. But as we see that the more expensive you are, the margin of error is low. So our preference order still remains HDFC Bank and ICICI Bank as top pick in the private banks, and we'll be buyers at every correction there.
Okay, that's the view. That's Nudul, Zee?
In our profile, it's a avoid. It's a clear avoid. While I understand that it has corrected even from valuations in absolute terms from the top, but what you have to realize is over the last 5 years, Zee got re-rated at every interval period of time. Hence, to look at a mean perspective is going to be wrong, because this is the first time after a long gap that you are seeing a FCF negative. And I really don't know if FCF will be positive for FY21 or not. Because if the ad growth revenue doesn't come back, then it's tough for the company. With the investments on G5 and content and everything, while pledge overhang gone has helped the company to be re-rated from 240 odd levels to 300. What we need to understand is 300 is where the deal happened. So if the company doesn't give growth, a lot of people who bought at those levels for medium to long term will continue to start selling. So my sense is 300 to 320 is fairly valued or slightly higher than that, and that is a zone where investors may look for some exit. So both from a fundamental and valuation perspective, Zee is a avoid for me, both in short term and medium term, until we see some green shoots coming both on FCF and ad revenue growth. That's a parameter we are closely tracking there.
Okay, so that's